Welcome back to Smart Stock Sam, the channel where the smart money gets exposed before it ever moves. And today, I have to open with something that I love to do. A prediction came true, not approximately, not in the general direction. Penny for penny, level for level, down to the exact dollar. If you watched our last deep dive on NIO, you already know we flagged a specific danger zone, a specific pin level, and a specific trapdoor number. Every single one of those levels played out with jaw-dropping, almost eerie precision. But here is the question that should be burning in your mind right now. If the prediction was that accurate, what does the next setup look like? Because here is what nobody else is talking about. NIO is absolutely dominating on the ground, posting record-breaking delivery numbers that would make most EV companies extremely jealous. And yet the stock is sitting here at roughly $5, looking like a company on life support. So why is one of the fastest-growing electric vehicle companies in the entire world being punished like a failing startup? That is exactly what we are going to expose today. The institutional shadow play, the dark pool suppression, the options chain physics, and the exact trapdoor level that could trigger a catastrophic collapse if it breaks. Stay locked in, because this one is going to permanently change how you look at this stock. Let's start with the disconnect that should make every rational investor stop and stare. NIO recently closed at just $5.02. That is a savage 29% haircut over the past 60 days, dragging the stock all the way down to a brutal 3-month low. If you only looked at the price chart, you would assume this company is in freefall, maybe even circling the drain toward bankruptcy. But then you look at the actual business. Deliveries did not just grow, they exploded. 62.3% year-over-year growth, record vehicle margins of 18.8%. In a macroeconomic environment where almost every other EV manufacturer on the planet is slashing prices and torching their own profitability just to move units off the lot, NIO is doing the exact opposite. They are expanding margins. Let that sink in for a moment. The fundamentals are screaming growth. The stock chart is screaming panic. This is textbook cognitive dissonance, and our entire thesis today is built around one core idea. NIO is severely, artificially dislocated from its intrinsic growth metrics. Not because of bad business decisions, not because of declining sales, but because of heavy institutional shorting, complex derivatives pinning, and geopolitical headwinds that have absolutely nothing to do with how many cars they are selling. Now, before we go any deeper, let me walk you through exactly why this analysis carries real credibility today. In our last video, I told you precisely what was about to happen going into mid-June options expiration. I said NIO was acting like a coiled spring, mathematically and magnetically pinned to the $5 strike level by institutional market makers. I gave you a strict hard stop-loss danger zone at $4.95. And what did we get? Absolute pinpoint precision. On day one, the stock opened, swung wildly, tested our danger zone, held the line, and closed at $5.05. On day two, the gravitational pull we forecasted dragged the price down to an exact intraday low of $5 before closing the session at $5.02. The $5 put wall was defended flawlessly. By holding that critical level, the stock completely avoided the delta hedging death spiral I warned you about. The prediction was validated down to the penny. Now ask yourself, if that level of analytical precision is possible simply by understanding how institutions operate beneath the surface, what kind of edge does that give you going into the next setup? Here is where it gets really interesting. While retail investors are panic selling on every red candle, the biggest institutional money on Wall Street is quietly moving in the exact opposite direction. The average institutional price target for NIO right now sits at $7.26. With the stock pinned near $5, that is a gaping 40+% upside gap just to reach what Wall Street collectively considers fair value. And these institutions are not just talking about it, they are buying the blood. BlackRock, one of the largest asset managers on the face of this earth, practically doubled its stake in the first quarter of 2026, aggressively scooping up 10.73 million shares, while the price was artificially suppressed. CYVN Investments is holding firm on their dominant 17.9% stake, displaying extreme sovereign-level patience. Inside the company itself, there is zero panic selling from executives, just routine options activity from insiders like President Qin Hong and Zhou Xin. And to cap it all off, NIO just locked in a significant new EV technology partnership with Bosch. When insiders are not fleeing and the biggest institutions on Earth are doubling their positions, you have to ask yourself, what do they know that the average retail investor is completely missing? The answer lies in the war NIO is currently fighting on two completely separate fronts. On one side, you have the internal operational triumphs that would make any serious growth investor deeply excited. NIO recently transitioned away from expensive third-party hardware to their own proprietary in-house Shenji smart driving chips. That single engineering decision is saving the company 10,000 yuan on every single vehicle rolling off the assembly line. They even achieved their first-ever quarterly adjusted operating profit, a genuine, meaningful milestone for a company that has been investing heavily in infrastructure for years. The business model is undeniably working, but on the other side, there are powerful external forces actively suffocating the valuation like a python wrapped around its prey. It is a brutal tug-of-war between a thriving, rapidly expanding business and a rapidly shrinking global appetite for risk. So what exactly are those external forces? Let me break down the two darkest clouds hanging over this stock right now. The first is the geopolitical risk premium. The U.S. Department of Defense recently added NIO to its 1160H Chinese military company designation list. NIO aggressively denies this and is actively fighting it through every available channel. But here is the brutal short-term reality. It does not matter whether the label is accurate or not. This designation absolutely terrifies compliance-bound institutional capital, forcing fund managers to sit completely on the sidelines regardless of what the fundamentals say. However, and this is the critical piece, if NIO successfully clears this designation, that geopolitical risk premium evaporates overnight. And when fear-driven capital suddenly has permission to flood back in, you get an aggressive and violent re-rating of the stock price. Could NIO clear that list and trigger a short squeeze that virtually nobody in the retail world is positioned for? That is a question genuinely worth sitting with. The second headwind is the industry macro slowdown. NIO's own CEO, William Li, is sounding the alarm bells publicly, projecting that Chinese domestic retail auto sales could plunge by an astonishing 15 to 20% in 2026. He has bluntly called it a brutal final stage for the industry. To survive this domestic contraction, NIO is betting everything on aggressive margin protection and aggressively expanding its export footprint through new sub-brands like Firefly. This is not a business retreating. This is a company adapting under extreme pressure, but the market is pricing in the fear, not the adaptation. These macro fears have completely crushed the technical picture, and the charts right now genuinely look like a crime scene. The price at $5.02 is trading heavily below every major resistance level. The 20-day simple moving average sits at $5.41. The 50-day is at $5.90. The 200-day is at $5.82. All 12 major moving average indicators are currently screaming strong sell. If you only read the technicals, you would be sprinting for the exit. But here is the secret that the algorithmic trading bots will never tell you. We are reaching a state of extreme technical exhaustion. The 14-day relative strength index is bleeding out between 36.18 and 37.58, firmly in oversold territory and desperately searching for a firm floor. The MACD momentum is deeply negative at negative 0.033. The Williams %R is buried at negative 75.03. When you stack these oversold signals on top of a high beta compression reading of 0.90 to 0.93, you have the textbook set up for a violent snapback mean reversion bounce. The spring is fully compressed. The question is, what catalyst finally unlocks it? But here is something even more revealing about this extreme technical compression. Historically, when a high beta growth stock like NIO reaches this level of RSI exhaustion while simultaneously sitting at a major options pin level, the subsequent reversal moves tend to be fast and aggressive, not a slow grind upward, a sharp, violent snapback that catches the maximum number of people leaning the wrong way. Think about it this way. Every short seller who piled in over the last 60 days is now sitting on a comfortable paper profit. They feel safe. They feel smart. That comfort is exactly what makes a short squeeze so devastating when it finally ignites. And with 144 million shares short at a near-zero borrow cost, there is a colossal amount of potential buying pressure that could be forced into the market in a very short window of time if the right catalyst appears. To truly understand who is pulling the strings here, you have to step completely out of the public market and into the shadows where the real action is happening. Right now, there is a massive, suffocating short overhang of 144.49 million shares betting against NIO. That is approximately 5.8 days to cover. But here is the part that makes this particularly brutal for the bulls. The borrow fee is essentially zero. It is sitting at a microscopically low 0.30%. That means short sellers feel absolutely no financial pain or pressure to close their positions. They can hold these shorts indefinitely at almost no cost. And if you look at the dark pool activity, the private off-exchange venues where institutional giants quietly execute their largest trades, off-exchange short volume has spiked as high as 51.7% in recent weeks. Let me be crystal clear about what that number means. This is not organic retail capitulation. This is deliberate, coordinated, institutional price suppression happening in the dark, completely away from public market scrutiny. And that dark pool suppression feeds directly into the single most important mathematical dynamic currently controlling NIO's price: options pin geometry. The stock is not trading on its delivery numbers. It is trapped in a mathematical derivatives cage built by institutions. On the upside, there is an absolute fortress of 11,525 call options sitting precisely at the $5.50 strike. Institutional call sellers are going to defend that ceiling aggressively, capping organic rallies so they can pocket maximum premium. On the downside, there is a massive block of over 9,318 puts sitting right at the $5 strike. Market makers are financially incentivized to keep the price pinned exactly at $5, burning retail put buyers and expiring the maximum number of contracts completely worthless. The stock is essentially caged between two powerful opposing gravitational forces, and truly understanding that cage is the only way to trade this situation intelligently. But what happens if the floor breaks? What if $5 does not hold? This is where the situation transforms from a controlled compression into an absolute nightmare, and I need you to completely understand the mechanics of what I call the trapdoor effect. Here is how the cascade unfolds. Step 1. The key support level officially fails. Step 2. Those 9,300 plus put options at the $5 strike suddenly flip in the money. Step 3. The market makers who sold those puts are now exposed to catastrophic mounting losses. To protect themselves, they are forced to aggressively short the underlying stock to delta hedge their exposure. Step 4. We enter a catastrophic liquidity death spiral. The algorithmic selling triggers even lower put strikes, which forces more hedging, which drags the price down further, which triggers even more forced selling. The cascade feeds itself relentlessly, and the critical number to watch is $4.95. If NIO closes below that level, the trapdoor opens. Could this stock see a violent, algorithm-driven flush all the way below $4.50 before any meaningful recovery begins? Under the right conditions, that scenario is absolutely not off the table. Knowing that danger exists in advance is what separates informed, prepared traders from the ones holding the bag. So how do we actually trade this situation? Your entire approach depends completely on your time horizon because these are two very different games being played simultaneously. Tactically, for the next 1 to 4 weeks, you cannot ignore the market mechanics. You must stay hyper-focused on the options pinning, the dark pool volumes, and the delta hedging floors. Watch for daily closes above $5 to confirm ongoing market maker defense. Watch for any developments on the DoD 1160H list. Watch early sentiment around new Onvo L60 deliveries. Your entry zone sits in the $5.05 to $5.10 range. Your first target on a confirmed bounce is the $5.37 to $5.50 zone, where the 20-day moving average crashes directly into that massive call wall. If a positive catalyst sparks a short covering squeeze, target 2 is a run toward $5.82 to $6 flat, clearing the 50-day and 200-day moving averages. Your hard stop is $4.95. No exceptions, no rationalizations, no emotional debates with yourself in the moment. Strategically, for investors with a 1 to 3 year horizon, tune out the options noise entirely and focus on 3 fundamental pillars. First, the profitability floor. NIO must maintain those 18.8% vehicle margins in the middle of a brutal industry price war. Second, swap monetization. They need to hit a break-even utilization of 64 swaps per station per day across their 3,794-plus stations. Third, sub-brand dominance. CEO William Lee has explicitly stated the Onvo brand needs to reach 55% of total sales. If the Onvo L60 cannot steal meaningful market share from the Tesla Model Y, the entire mass market growth thesis collapses. Before the final wrap, I want to be completely transparent with you, because that is what this channel is built on. Nothing in this video constitutes financial advice. Everything discussed here is purely for educational and informational purposes. Investing in individual stocks, particularly in the electric vehicle sector, carries significant and real risk. Past prediction accuracy does not guarantee future results. Market conditions, geopolitical developments, and options dynamics can shift overnight without warning. Always conduct your own thorough due diligence, consult with a licensed financial professional, and never invest capital you cannot afford to lose. The market is unforgiving to those who skip this step. So here is the bottom line. NIO represents a masterclass in institutional market mechanics, violently overriding strong business fundamentals. A company with 62% year-over-year delivery growth, near 19% vehicle margins, and a first-ever adjusted quarterly operating profit, being held hostage by a 144 million share short float and algorithmic options pinning. Short-term, tactical trading remains caged between the $5 floor and the $5.50 ceiling. Mean reversion bounces are highly viable, provided you respect that ironclad $4.95 stop loss. Long-term, the 40% upside toward that $7.26 target only unlocks when the geopolitical risk premium clears and Onvo proves it can win the mass market at scale. Now I want to hear directly from you in the comments. Here is your question. If NIO successfully gets removed from the DoD 1160H list tomorrow morning, do you believe it gaps straight up to $6, or does the short overhang absorb the entire move and cap the rally below $5.50? Drop your answer below. I read every single comment, and your perspective genuinely shapes the direction of the next breakdown. If this video sharpened your analytical edge and showed you something you were not seeing before, hit that like button right now. It literally takes 2 seconds, and it helps this channel reach more serious investors who deserve access to this kind of analysis. Subscribe and ring the notification bell so you never miss the next setup before it moves. And if Smart Stock Sam has ever genuinely helped you, if one of these breakdowns helped you avoid a bad trade, size correctly, or catch a move early, please consider sending a super thanks using YouTube's built-in support feature. Every single contribution goes directly back into the research, the tools, and the content that keeps this channel ahead of the institutional money. And finally, The Smart Stock SAM membership is officially live. This is our exclusive investing and trading community where members get early access to full breakdowns before they publish, complete trade setups, priority replies to your queries, and a community of serious, disciplined traders all doing the real work together. If you are ready to stop trading in isolation and genuinely level up your investing game, the membership link is right below this video. Stay sharp, stay patient, and I will see you in the next one.